that's definitely how I perceive it for my trading. You got it. Let's see, Joseph asks, is a thrust pullback thrust on the 5-minute, not 15-minute, confirmed by the 60? The 5-minute, the 15-minute, you can take a thrust pullback thrust on a 5 or a 15-minute chart. Both should be consumed or confirmed, excuse me, by the 60-minute chart. Now, if what you're asking is, do you only care about what the direction of the 15-minute chart is versus the 5, then I would say what you're doing there, Joseph, is you're just basically more in scalper mode than you are more trend trading mode. If you've got that hourly trend in your favor, you're more likely to be able to potentially go for bigger profit targets versus if you think about that, if you got the 5 and the 15-minute in your favor, but it's against the 30-minute and the 60-minute chart, you run a much bigger risk, Joseph, of going ahead and actually having it do what? Roll right back against you, right? So from a higher probability perspective, and that's what this section is actually talking about. This section here, we're talking about the higher probability, the more what I would perceive to be more conservative entries versus more aggressive or scalping entries. Okay, so want to kind of cover both, sides of that paradigm there. All right, and so that would be like a thrust pullback, thrust type trade. Again, the 5-minute, the hourly charts pushing in the direction of that push down. And the market, in my opinion, will be far more forgiving in an environment like that. David, exactly. What I was using this bar as an example for just that reason. David says, how does this fit in with your comment that you wouldn't enter a trade in the direction of the trend where there's a, okay, there's a big difference here. David says, in the direction of the trend where there is a 50% pullback in the bar. Here we're talking about a 50% close, David. The thrust pullback thrust trade, remember what I said when I started out my comments on this? The thrust pullback thrust trade, it's an intra-bar trade. So what happens is the market comes down, comes back 50%. I take my entry when it gets around that 50% level, in my short side, in this case, short side trade, and then go ahead and look to be out by about the time where it made the initial low. So let's get the drawing tool out here to be very clear, because I take these trades a lot and they're a lot of fun. So make sure that we're clear. Okay, so we've got a market that thrusts down this much. Let's just say it's 30 ticks. Okay, I've got tone and lock in the background on the 5-minute and on the 15-minute chart. So what I'm looking for then is to come back. Typically, it's between 38 and 50%. Okay, 38 to 50%. Looking for it to retrace. Then I want to take my short, and then I look to be out of the trade usually by the time we get back down to the low of the bar. And the reason being is because that low of the bar can be support. And as I was talking with Gloria about earlier, you never know if it's going to go ahead and reach for a new low, or it's just going to hold at that previous low, shore up support, and start to go back up. So what I look to do is it thrusts down, pulls back up, okay, in the direction of that trend down. I got my indicators coming down on the 5 and the 30 or 60, and then I'm looking to go ahead and short, and then looking to be back out by here. That's why the more it can stretch initially, the better. Because if you think about it, let's say this was 1 tick and this was 10 ticks. Well, guess what? If that was a 10-tick move, a 50% retracement only gets you to the 5-tick mark. By the time you take out a tick for bid, tick for offer, and try to get out a tick or so below the bottom here, now suddenly you're down to only a couple of ticks profit. That's why I always look for this thing to stretch 25 to 30 ticks. Okay, so that when it pulls back, that there's a reasonable profit opportunity still left in there. Okay, but there's a big difference between a bar going ahead and closing at the 50% level And David, I know you're new, so you haven't gotten to hear us talk much about these on an intrabar basis. What I usually look for is within the first 2 to 2.5 minutes, David, for this to go ahead and push down the 25, 30 ticks. Okay, and then from there, I want it to snap back up in the around the middle of that bar in the 2-minute to 3.5 minute bar mark, giving the market time for it to come back down to retest these lows. Okay, that's a big difference, as you guys know, in the live trading room. If this happens, this big 25 tick move happens, or more, 25 tick plus move happens in the last minute of the bar, I usually do what? Do I take the trade or do I pass on it when it usually happens in the last minute of the bar? Exactly. Pass, back off, because I'm then too concerned it only has enough time to retrace and just get back up to that 50% level before the 5-minute bar locks in, and voila, then all of a sudden I would be left with this kind of bar, which is exactly what I don't want to have happen at the close of the bar. So a thrust, pullback, thrust, David, is in the middle of a trade that's taken in the middle of the bar with time to, retrace and give me a profit potential, versus a bar that pulls back 50% with only a handful of seconds to go, where it could then end up closing 50% off the low, which could be a bad thing. Okay, you're welcome. But also, even with that, David, one of the reasons, and that's what I'm trying to emphasize here, even let's say you got trapped at the end of that bar, if you notice here, just like what we're looking at with this environment right here, the market, when you have that 5-minute and that hourly trend and indicators firing off, it ends up being far more forgiving. You see what happened here. This bar closed here. It went up a few ticks, assuming the short was taken right at the close of this bar for some reason. It went up a few ticks, two ticks or so against you of heat, and then you end up moving down from there. Okay, so the market is far more forgiving of your mistakes, in my opinion, for my trading, if I focus heavily on getting good indicators and good trends. Okay, so good questions there, good discussions, and so let's talk about next the pullbacks. This is a favorite of mine. This is probably one of the single most common trades you see me take in the live trading room. So in fact, like I said, it's one that was actually taken from today as well. As we look at the trades, what I'm looking for is I'm looking for the indicators to give me those nice, clean, rapid-fire signals in the background. Okay, the more signals on the higher time frames, the better. Okay, so what happened here was, notice we had nice rapid fire. We had what I call rapid fire. Rapid fire is where I have all three of these, which is tone, lock, and fire. These three back to back. So these three makes what I call rapid fire. Okay, but the entire time throughout the morning here, or throughout the evening, excuse me, last night, we had nice tone, okay, to the downside. That's on the 15-minute chart. Now, let's go ahead and look at the hourly chart. Okay. Last night, what did we have? We had real nice tone and lock, didn't we? And we even had, at one point here, rapid fire. Okay. So let's go ahead and pull this back over. We'll get, no wonder I'm looking at the 30-minute chart. I'm like, that's not right. Let's get it back to the right chart there. There we go. All right. Now, notice in the background here, and this is important. This is the way I take these trades, so this is what you're really going to want to focus on. In the background, I saw rapid fire and good tone and lock. Okay, lots of that on the 15-minute chart. All right. In the background on the hourly chart, and let's get it back to where we were, we also went ahead and had real good tone and lock. Okay. So the tone, of course, I told you is very important to me. And when I see tone and lock in the background, that gets me even more excited. All right. So, and then we'll just kind of go back and just look at this one more time from a different perspective, which is the 30-minute chart as well. Note on the 30-minute chart here. Okay, here's the 30-minute chart. This is at the time when I was taking this trade earlier. Okay. The just before that, in the background, we had good tone and lock. So in the background on the 15-minute chart, I had good tone and lock. The 30-minute, I had good tone and lock. And the hourly in the tone and lock in the background there. No buy-side signals whatsoever. Everybody see that? No long side signals here. No signs of strength whatsoever. Okay? So when this went ahead and made its first retracement up there to that downtrending 20-period moving average, I went short. And I was just getting ready to go to bed. In fact, the only reason I was even here was to go ahead and get the webinar set up for you guys, for those of you that wanted to, come join me, okay, in the overnight trade. So the, yeah, I was right up there near that close. Exactly, Tim. So basically I had all this in the background. I had tone earlier. I had tone and lock in the background here. Tone and lock. All the efforts here were showing weakness. Okay, weakness in the background. So when we hit the downtrending resistance, I took that short. Now, I cut it short because, of course, I was getting ready to go to bed. I literally was working on this presentation for you guys all weekend long. I said I met with John M. for dinner. And again, John, that was a lot of fun. Thank you very much. Met with him for dinner Friday night. And then after we got done Friday night, I came back and then Friday, Saturday, and Sunday worked on this presentation. So I was pretty well burnt out on market activities by Sunday evening. But I couldn't resist because it happened to be popping up there at just the opportune time, right when I was here getting everything set up. So I took a quick trade there. Okay, but you see in the background, having all that weakness on multiple time frames, tone and lock in the background, and tone throughout the whole process really is awe-inspiring for me to want to go ahead and take that trade. Now, again, the way I usually take these trades is off the 5-minute 20 period, 15-minute 20 period, 30-minute 20 period, or hourly 20 period moving averages. Okay, and the way it usually starts out is most of the time that I focus on taking that entry on the 5-minute chart first. So the market's been coming down. We got the good tone up here and locks. We got good sell signals on the top there, and then the market comes up, hits the 5-minute, and I'll take that trade first. Then it's kind of done away with that, and now all of a sudden it's now we're on to the 15-minute chart. Okay, now this is the 15-minute chart. It'll come up, and then I'll look for a trade off the 15-minute chart, and then go down. Okay, and I keep moving on up the time frames there. All right, and so I'll look for retracements off of the 5-minute first. Then as it starts to kind of weaken a little bit on the 5-minute, I'll look for retracements up to the 15-minute. Then I'll look for retracements up to the 30-minute. And then I'll look for retracements up to the hourly chart. Okay, that's basically the way I utilize that. So retracement trades are one of those core trading principles in my arsenal, and that one of the key ways that I'm using those is to go ahead and let's see here. JJS, so that means you have 4 trades or use them to scale in. That's right. That's right. Because if I take an entry on the 5-minute chart, and let's say it pushes up through that, I'll be definitely looking to scale in at the 15-minute chart. Absolutely, especially when we have such strong trends like we had here. We had a beautiful senior trend in the background here on the 60-minute chart. You can see a beautiful senior trend here. I was talking about those trend count systems with Gloria earlier. So you've got a good trend count system in the background. You've got the indicators going off with, tone and lock, and in some cases rapid fire right in the background. There's basically a lot going on. It's all pointing the same direction. No signs of strength right in there during that trading period, as I was showing you earlier. Let's get back up there. No signs of strength, even on the the 15-minute chart. So that's the kind of trade that I'm looking for, is higher probability. I got senior trends in place. I've got the indicators in place. I've got tone. In many cases, I have tone and lock in the immediate background. Those retracement trades are the kind of things that I'm looking for. So that's an example of a retracement trade. Okay. Now, I'll tell you, as we talk about higher probability, I think these retracement trades, in my mind, work better to the sell side than the buy side. I know some people argue that with me because some people have used this work of mine very successfully to the buy side. But the reason why I say that is because my experience with markets that sell off versus markets that rally is that that we talked about earlier about bottoms being more complex than tops. So what my experience has been, as the market's rallying here, have I gone ahead and taken plenty of trades where the market's been shooting up? We've got the buy side indications here, and so when it pulls back, do I take a long? Sure. Absolutely. What I just want to make sure people understand, because people don't understand this, they treat buy-side signals equally to sell-side. And my experience, and this is just my experience talking here, I found that when I take the long side trades, that I have to be mentally willing, okay, to either A, take a stop out right below, or B, understand that more often than not, I may need to go ahead and actually take, like a scaling opportunity or hold it for longer, because when the market gets selling, sometimes that momentum carries it through to really spook out all those longs, those weak hands, those weak holders. How many of you have ever been in a long side trade before, where it goes ahead and it pulls back and it just looks like it's the end of the world coming, only to go ahead then so trade through your support, trade through your stop. It trades through there just a little bit, and ultimately, next thing you know, comes back up a little bit later, okay, or a few minutes later, a few seconds later, sometimes, unfortunately for some of you. What happens is the intensity, the veracity to the downside. Well, here, once or twice. Well, look at it this way. Think about this for a minute. When was the last time, and this will probably illustrate the point, just fine for people, okay? On this day right here, remember that fantastic Thursday, okay? On that fantastic Thursday where the market ended up going ahead and dropping the way it did, over 1,000 points on the Dow, how many days do you see like this to the upside? How many days do you see like this to the upside, gang? 1,000 points to the upside that comes back and takes away 500 of the points or more. Exactly. None. Okay. But yet they went ahead and were able to do that to the downside. Okay. So, my point well taken. How many of these bars do you see are big, wide-range down bars? Okay, just look back here. How many of these were big, wide-range down bars versus wide-range up bars? Clearly, you can see more down bars, wide-range down bars, than up bars. It's a lot easier for them to panic people out of these long side trades. Okay, and so it's a lot easier to get slippage in there and have it be sloppier to the downside. Okay, and so my experience has been, and this is just one of those tips for you to think about. You can go back and kind of check that for yourself in off hours. A little homework assignment for you there. But basically, what my observations are is typically tops are gone ahead and usually made, on average, more succinctly. Where the market runs up, hits that top, you get a sign of weakness at the top, and it rolls right over, versus bottoms, which can panic people down, goes up a little bit, panics some more down, okay, and gets more complex in nature. And we talked about that a little bit earlier, but I want to remind people of that, okay? So with that being said, the whole point of this conversation is to remind you that when you're going long, okay, and the market's pushing up here, well, I tell you what, never mind. We'll just look at the real life example. Here it is right here, gang, right in front of you. Exactly what I was just describing. Let's just go ahead and highlight it right there. Everybody see that? So it spiked up, it came back, okay? We had mostly buy-side indications in the background, tone and lock. Is everybody following me here? Can you all see this on the screen okay? Look what happened. It shot through there, 2 to 3 S&P points, and guess what, gang? Where are most trader stops on the S&P? At 3 S&P points or less, 12 ticks or less. So guess what they did? They get it right down there. So all those junior traders who put their buys in right there at the or the 1070 level, they turn around, they bring them, guess what? 1 or 2 ticks below the 1067 level. They stop them all out, and what does it do? Turns right around and spikes back up. Everything I was just telling you, we saw right there in the S&P today. Okay, so are you following me here? This is really important to understand that from a long side perspective, there's a far greater risk of exactly this kind of thing happening where they run it through your support level, and ultimately it may go right back up. But of course, for the average junior trader, they hit that. I mean, is it any coincidence that happened to be about a 3-point run from right here, the 1070, round number, nice 20-period moving average pullback? Is it any coincidence that it went from there right down here a tick or two below the 3-point stop out limit? I've done numerous surveys with you guys in the live trading room over the years. In the chat rooms, that I've been there with you guys in the past, every time it's very consistent. The average trader has between 6-tick and 12-tick stops in the S&P. Very seldom have I ever met anybody who consistently has more than a 12-tick stop in the S&P. And with that said, that means the vast majority, almost all of the traders got stopped out on that little 3-point run right down there through the support level at 1070, stopped them out. They're miserable. They're stopped out of their trade. And then guess what it does? Turns right around and goes back up and could have made them 3 or 4 points. Okay? So I rest my case on that. That's an excellent example right there of exactly what I was just trying to share with you. Okay? All right. So with that being said, let's go ahead and talk about fish hooks. Okay? Now, fish hooks, of course, we actually talked about those a little bit this morning in the live trading room. And, we'll go ahead and we'll kind of carry that, conversation on here. Now, a fish hook, of course, is a move to the upside. You can see it on a bar chart, or you can go ahead and see it like on the RSIs. That's one of the reasons I have the RSIs. Looking for a nice, clean hook like this, not one of these things. Okay, nothing sloppy. Okay, not like this, where the backbone is sloppy. Nice clean approach up, nice angle back down. Okay, nice and clean there. All right. So, because what my expectation is, then the next bar will be to the upside. Well, how does this interact with the indicators? If I've got that good tone and lock in the background, then this is likely to be far more, it increases the probability of success quite a bit if I've got that pullback within the background of tone and lock. Okay. All right. So let's go ahead and just take a look at a couple of charts here. And again, no pre-made examples today, gang. It's just all got to be done right on the screen in front of you. And, that's, so, it may take me a moment to go ahead and find the examples, but that's okay. It really needs to be that way. So what I'm looking for in a downtrend,